Open banking. I recently listened to a large accounting firm talk about open banking and how this is being used to make applying for finance simpler and less hassle. How it was streamlining the process and how it was fast becoming the norm. How it was being used to make the borrower's life easier. I couldn't believe just how wrong that statement was. It was bordering on the naive, as open banking goes so far beyond that when it comes to borrowing. Lenders are using open banking more and more, and that's very true. And it does make applying for finance simpler and quicker, but not necessarily easier. What the majority of businesses, and for that matter most people, what they don't understand is just what happens to that data when it is imported via an open banking link. You see, traditionally, when a bank asked you your bank statements, they were looking for bounced items. That was a standard warning notice that a potential borrower may be struggling and maybe that client wasn't a great credit risk to take on. For many mainstream lenders, that rule still applies. But open banking is changing that. When a lender pulls bank transactions into the system via open banking, the AI and the system that processes that data does so much more. And I want to try and show you what it does because it is simply not understood by businesses or their advisors. Now, I'm going to show you a real life report generated by a lender who used open banking. The confidential bits have been redacted, but the rest is a genuine example. Let's start with money coming in. Remember that all of this happens automatically and instantly. The system assesses the money coming in. It segments it into credit, grants, government funding, invoices, transfers, etc. Straight away, the lender gets an overview of the money coming in and where it has come from. High turnover accounts, they no longer signify a well-run business. On an application, the borrowing business, will have put down details of other creditors. The system already pulls in that detail. It looks at what's been received and what's been paid out. A question about what other borrowing you've got, well, it's checked instantly. And what about the transactions themselves? The software used will highlight significant transactions. In this case, we can see the system highlighting the use of the job retention scheme, of loan funds being credited. It also highlights possible missed payments. This means that the software has checked and looked at what normally happens and identified when that wasn't the case. It will also look at what the business owners have taken out. In this case, we can see a refund of a small milk purchase, as well as some regular dividends being taken. My point in showing you this is to give you an overview of what open banking gives the lender, and why the answers you put on the application form are checked in ways that they never were before. If you think open banking is about making the life of the borrowing business easier, well, yes it is, but that's not the primary aim. This is about real micro-analysis of what is happening and all done in real time. For those businesses that don't understand why things are changing or think this is about ease, then you're going to find life a little bit more difficult. Open banking is a simple concept. The devil is in understanding how your information is being processed. Something that very few people will ever properly explain to you. I hope that helps. I hope it gives you a better insight into what happens. And if it raises any questions, then drop me a line and let's talk. Follow us on social media, stay in touch, and we'll speak again very soon.